Welcome back to SAV Live. We're doing a bit of a wrap-up series. My name is Kai Hoffmann. I'm the @JR Mining guy on Twitter and the CEO of the Soar Financial Group. As I said, we are wrapping up 2022. We're recording today on December 28th, and we'll be joined in a few short seconds by Jim Iuorio. And before I switch over to my guests, make sure to hit that like and subscribe button as well, because we got more great guests coming on. We had on Rick Rule already. We had Lawrence Lepard. We had, drawing a blank. Our good friend Andy Schechtman on as well. It was the most watched video on our channel. How could I forget? And we got lots more coming on. Alistair McLeod. We got Warren Irvin coming up later in January, and many, many more great guests. So make sure to subscribe to the channel to get an understanding of what happened last year, meaning in 2022. And also, we're trying to bring out the glass ball and look forward a little bit, see what's happening in 2023, predict the markets as good as we can. The global macro environment is going to throw us a curveball tomorrow anyway, so take everything with a bit of grain of salt here that we're saying, but we're trying our best. And Jim, it's great to have you back on. It's good to see you again, my friend.
Thank you.
Yeah, we only spoke early November, late October. So let's try to put a bow around this year and appreciate your time, obviously, here on December 28th. I'm sure there's lots of things you could do in the slower times of the market here. But help us put a bow around it. 2022, crazy year. What was something that comes to mind, or first thing that comes to mind when you think about the last 12 months?
Well, okay, so when you look at 2022, overwhelmingly, one theme was by far the biggest theme, and that was global rates going up. More specifically, Europe. Act like is a little bit disingenuous. Did I freeze up there, Kai?
You did, actually, yeah. You might have to repeat the last sentence, please.
Okay, so to act like there's cross currents that are almost as important is somewhat disingenuous. Rates going up is by far the most important thing. Second on the list, but a distant second on the list, is China. It's zero COVID policy, which the markets didn't really understand, and now China coming back online, which the market wants to have optimism in that, but they understand that now they're actually going to have to deal with actual COVID like most of these other countries did several years ago. So I hate to even say this, but the next month, 2 months, is going to tell us a lot about China and how the reopening process is going to be. Now, the third thing on the list is Russia invading Ukraine. It's a big deal, and I don't mean to belittle it at all, and it certainly had effect on energy prices, particularly in Europe. But to take anything away from the fact that the Fed and pretty much every other central bank set their sights on inflation and raise rates aggressively in response to that is by far the biggest thing. So going into 2023, you have to ask yourself, what's going to change? Well, the rate picture is certainly going to change. I mean, I can't imagine that the Fed is going to keep hiking rates with abandon for even through the next quarter. China's reopening is going to succeed at some point in time. And then all that's left on the table is Russia, Ukraine, which could develop into something major, don't get me wrong. But at this point in time, it's the distant third, in my opinion.
No, absolutely. And I think the battle has lost a bit of steam, although I'm not sure Putin seems like there's more saber rattling going. But let's table that discussion for a second, because I want to talk about sort of the Fed policies and what's going on there. And I'm looking at the US dollar as well. When we spoke, we sort of said, okay, the US dollar Dixie is losing steam here. And it has. We've dropped right around 8-9 basis points since we last spoke. How does that fit together with what the Fed is doing?
See, I think that's a big deal. And I think last time we talked to, and the speech at the New Orleans Investment Conference that you were at in early October too, my focus was on metals. And I'm not just saying that at all because you guys are involved in metals. I think the dollar had hit its high, in fall. And I think now is the time, because the aggressive policy has to start to come, the aggressive Fed policy has to start to dissipate. And the point here that I make this point all the time, and people don't seem to understand, is that every one of us agree that Fed policy does not hit instantly, and there's an enormous lag effect. That lag effect could be 6 months, it could be 9 months, but there's a lag effect. So if the Fed is going to wait to see efficacy in their policies, it will mean by definition that they had achieved the right policy 6 months earlier. So I think that something is going to be broken to the other side and cause the Fed to have to ease in 2023. And that's not just my opinion, by the way. The Fed funds futures curve is saying 2 more 25 basis point hikes and then start to ease by the end of last year. Now, to be fair, it was saying 50 basis points of ease until recently, and now it's just saying 25 basis points ease. But I think that recipe, bad for the dollar, and if the dollar index futures close below call it 102.80. I think the next leg down is going to happen. And I think there's corresponding levels in all three metals that I trade, which is gold, silver, and copper. And I still think those are the places to be for a lot of reasons that I hope we can get into.
Yeah, we'll definitely have to touch on that. Like our channel obviously is very metals focused, but you said 102.80. We're trading at 104 roughly for the DEUTSCHE right now. Lost those 8 basis points. Is that like, it's interesting that correlation between gold and silver and the US dollar, like because we went from 1615 roughly when we were chatting last. It's been about 2 months to now 1800, 1830 actually at a top of here just days ago, I think. So,
Yeah.
is that really that gap closing? Because it feels like we're still in that trading range and nothing has broken yet to the downside or upside.
That's my point, is that we're in a trading range and we're consolidating. From a technical standpoint, that just is going to be gathering steam to the next move. And that's where patience comes in, because you have to wait for somebody else. It's so counterintuitive to people who don't trade for me to say, yeah, I want to sell the dollar index when it settles below 102.80, which is lower than it is here. People want to say, well, no, don't just sell at higher prices. No, we want to see the breakout of that level. And it's just like, it's like the 395 level of copper that corresponds kind of with that 10, let's call it 103 in the dollar index, just to be more simple. But the 395 level in copper too, I want to see a settle above there and a settle below 103 in the dollar index. And my guess is both those things happen at the same time because they're highly correlated or inversely correlated, whatever you want to say.
So many great topics like copper you brought up just now. I want to talk about the recession as well, like, or an upcoming recession. Like, how much do you fear it, and how much is it priced in already? If you look at the metals prices, for example.
So I think that it's definitely priced in, and I would also go back to the yield curve being consistently and persistently inverted for the last 6 months, telling us that financial conditions are too tight and predicting a recession. I know that the shape of the yield curve isn't absolute in its success rate, but to me, it seems like a pretty good notion that we are heading into recession. I'm surprised we're not here already. Even when you just look at things like before we started recording, we talked about the mortgage market and the housing market. Like to take interest rates, mortgage rates from 2.8% to over 7% in about 9-month time period is relatively unprecedented. To think that that doesn't have a just an aggressive impact on the housing market is silly. And all these housing analysts are predicting like, 5% pullback in house prices. Nonsense. I think that could be as high as 15% pullback in house prices. So in recession, economic activity is highly tied. Construction and the real estate market is a huge predictor. If that starts to break, I think the recession comes, which, by the way, everyone thinks when I say the recession coming means you don't want to buy metals because demand's going down. No, because I think the Fed will realize the folly of them putting rates up too high, too fast, and we'll flip around. And all of a sudden, we're going to have easy policies again.
Yeah, easy policies. Like, I'm always thinking about spending bills as well. Like if I look at China, for example, when they're spending, they're at least investing in infrastructure. Right? At least they're spending in a smart way. Like, I'm not sure if it generates positive returns in the long run, but at least they're investing in themselves. And while we in the US or even in Europe, everything just goes poof up in the air and it disappears to a degree, or it goes into crypto and also disappears. Right? That's why I was like, I'm with you when it comes to the metals. It's like it should theoretically flow into the metals. But what are you looking for? Like, looking at the omnibus spending bill that we just saw last week, I think. Anything flowing into infrastructure and metals?
So just because our government here says that they're earmarking such and such for infrastructure, I have very little belief where it ever ends up. The omnibus spending bill, to me, coupled with the Inflation Reduction Act, coupled with the infrastructure bill that was passed, I think about almost a year ago, but it's just starting to hit right now. It almost seems like our federal government in the United States is doing everything they can to make inflation worse. And yes, I did say the Inflation Reduction Act, highly inflationary bill. Just like in Spain right now, just passed a $10 billion bill to fight inflation. I don't have any idea what the hell that even means, except it just means that governments are trying to act like they're doing something to fight inflation, when in fact they're making it worse, perhaps creating a need for more action for them down the road. I don't know. This confuses me. I don't understand what they're doing, but it seems like they're working counter to what the goal is.
Yeah, one of the items discussed is just giving out more money to counter it so people can afford the higher prices. It's like, that seems counterintuitive, just sitting here, and that doesn't make a whole lot of sense. Jim, we're jumping around a little bit.
It's hard for guys like us. Oh, sure.
No, no,
No, you go.
no, go ahead. No, I love the
Oh, I
conversation.
was
Like,
gonna say it's almost a curse for guys like you and guys like me who know a little bit more than the normal guy on the street, because this is what we do and we study it. But then you can just you can beat your head against the wall saying, what's happening here, where everyone else is going, yeah, that seems logical. Give people money to fight inflation. It's not logical. The problem is people too much money chasing too few goods. To throw too much money in on the demand side will make it worse. This is not a theory that Kai and I came up with. This is settled science.
it's history too. There's a bit of financial
Yes.
history to it as well, right? And living in Germany,
Yes.
we've seen hyperinflation as well. So, and the higher energy costs are another issue. But I want to talk pending home sales real quick, because I think that's a really, really big indicator. A lot of people, a lot of wealth has been derived from home sale or from house prices or the market value of it. Like, how much value do you put on the housing market, mortgage rates, and then maybe I'll throw in car sales and the car market as well. I think those, for me at least, are two leading indicators.
Well, so both two of the most highly rate sensitive sectors that we have. To think that the housing market isn't going to suffer from the rapid increase in mortgage rates is silly. Now, here's one thing that I will add, and I still think there's going to be a 15% breakdown in housing prices just to blow the froth off what we've put on over the last 3 years. But we all, people of my age who've been around for a long time, have seen these things before. This is not the same as the 3-decade buildup to the great financial crisis that happened. That was a question of leverage, and the wrong kind of leverage. When your brother-in-law, who's an electrician, owns 5 homes that he's telling you about at Thanksgiving dinner, how he's rehabbing them and making all this money. That's when the real rug pull happened in the real estate market. This is a different sort of thing. But remember, 18 to 20% of those homes bought in the last 3 years were bought private equity, venture capital, like that Blackstone fund that has $80 billion of real estate. That's what I'm keeping my eye on, particularly. If that fund starts to get just bombarded with redemption requests, I think that'll be the last leg to push us down the 10 or 15% that I think could happen in real estate, but not the 45% that happened in 2006, 2007. So yeah, I think that my eyes in 2023 are going to be very hard on the real estate market and then the labor market, and we get to see unemployment next week.
Exactly. Like unemployment is another one. I'm just looking. I've tried to find. I thought I've seen California house prices or apartment prices coming down by 13%. I thought I saw that yesterday somewhere, but I can't find it right now while you were talking. I was trying to look it up real quick, but because we're already in that range where house prices are coming down, and I'm kicking
Right.
myself personally for not buying a house in Las Vegas in 2006, 2007 when they were giving them away pretty much for free. So,
Absolutely. Well,
so
that's, by the way, you just hit on something that's so important to remember, that the Fed gets involved in this and they end up pushing the pendulum so far to both sides. And now, right now, they feel like their backs against the wall because they know for certain, which everyone else knows too, by the way, that in June of 2021, the CPI printed over 5%. The housing market was inarguably on fire. Prices had gone parabolic. And what did they do? They kept their foot firmly on the gas for another 6 months, buying another $250 billion of mortgage-backed bonds, of housing bonds, to fuel a market that was already on fire. So now, and I don't mention this to point fingers at them, although I enjoy pointing fingers at them. I am mentioning it to try to dig down into their psychology, where they know they missed it so bad on the upside, and they're sure as hell not going to miss it on the downside too. So I believe they will overdo it, and boom, rinse, wash, repeat, and then all of a sudden they break the housing market down, creates opportunities for people with deep pockets, and then they start to fuel it back up again in a year.
No, absolutely. You brought up China as well. I know we're jumping around on topics here a little bit, but I find it hugely insightful. China coming back to market, what does that really mean for the global supply chains? Will it calm things down, or is it going to be more erratic? Like, what does that really mean, China coming back? They have Chinese New Year later in January as well, so I don't see them coming back in the next 4 weeks. It might be 6 to 8, and maybe even longer.
No doubt about that. The opening has been rocky, as it was always going to be rocky. I don't understand why people are confused by that. But I think part of the up move in copper that we've seen is anticipation of China opening up again. I remember whether it belong copper and China are so closely associated, and I always argue that if we dug down into the actual fundamentals of what demand, what production that China plays in the whole copper market, it may show a slightly different story than what the correlation dictates. But it doesn't matter to me. The correlation is the correlation. The point I'm trying to make is that if people think that supply chains are going to heal quickly if China's open again, wide open in 3 months, I think it's a bit of a mistake. I think these things take a very, very long time to heal, and I don't expect the supply chain to be 95% of what it was for another 2 or 3 years. So that part's inflationary. Plus, we don't have the same good relationship we had with China that we did a while back. So that makes sense too. On my podcast, I had Valina Chekarova, who has a geopolitical consultancy, and she was talking about supply chain suffering because of the geopolitical risk of China. And now we're in the process of switching our more friendly ties with India and switching some production there. These things take quite a long time. So I don't think we're going to see any real good results in that area for a couple of years.
Supply chain wise as well, you brought up inflation in that context. I'm looking also at the bulk dry shipping index as well. Costs for shipping goods are coming down massively. Or have come down in recent months as well. How does that factor in? Because I'm looking at inflation, right? And I'm looking at re-domestication of like production and deglobalization as well as a trend. Resource nationalism is the next topic I want to talk about, maybe to a degree as well. How does that factor in? Like, what's your view on inflation? Where are we going to head?
So, okay, so I mentioned what the things I just said made it seem like I believe that inflation persists, and I think to a certain degree it does. Because when Ronald Reagan took over in 1980, basically, let's call it 5 things happened, but only 3 of them are important to us. 1, Paul Volcker raised rates up. Is Jay Powell willing to do that? Absolutely is. 2, deregulation and privatization. Is our government willing to do that? No, absolutely not. They're not. They're going the other way on that. And the third thing, which you just mentioned, was globalization to try to take advantage of inexpensive labor in the developing world. Are we heading more in that direction? The answer to that is no. I won't even mention what the other 2 things were, but it has to do with technology. So the question becomes, is there a spot on the horizon where all of a sudden cooler heads prevail and we start to get along? And it seems like those things are glacial in their movements. So I don't anticipate that happen anytime soon. I'm hoping within the next 4 or 5 years, but that's very inflationary. But you mentioned the Baltic Dry Index, and I'll mention commodities as well. And we both know that commodities move on demand, but they also move on market position. Lumber is now lower than it was prior to the pandemic. That's significant, and that lumber was the thing we were talking about for the first 6 months as it went through the roof because it was connected to the dollar, it was connected to real estate. And now all of a sudden it's lower than where it was. So I think most of the inflation is done. I think the persistent part of it that'll stick around for a while will be the fact that government continues to spend and we're going to deglobalization more than globalization, if that makes sense.
Yeah, no, absolutely. And resource nationalism, I think I want to throw that in there as well. Bringing production home, but also sort of sourcing critical metals, base metals, copper to a degree as well. Like, what's your sense of take on that? Like, I've seen the US government give out grants and free money to some of the mining companies recently. Perpetua Resources got $24 million for their antimony, which I had to smile about a little bit because it's a gold project in Idaho. And antimony, I haven't heard of before, really. I know it's a side product, or a byproduct, but what's the point? So what's your take on that?
So what you mentioned, I think, is very fascinating because I like to talk about the environmentalist dilemma because there's so many of these metals that they want and need, and they just despise extraction because extraction is dirty. It consumes water. So permits take so much longer to have mining operations. By the way, permits to have mining operations in Chile have increased by like 3 times. And for those, I know Kai knows this, but for those watching, Chile is kind of the Saudi Arabia of copper. So new copper projects in there have to face a lot of regulatory restrictions as much as here. But the fact that our government seems to be starting to realize that you can't have your cake and eat it too, and they're starting to grant permits is a good step. I do worry that the environmentalist political faction will stop that sudden. The move to EVs and the move to green energy becomes a very dirty operation and it becomes very international. And if some of these countries are guiding their natural resources, that can be very inflationary as well.
Now we've seen some photos, or I've seen some photos of of the Congo and where the cobalt is coming from. But
Cobalt.
apparently,
Yeah.
reports have said like it's all hunky dory there. But now photos are circulating the web where it's like, well, it doesn't look like it if you take a look at the photos where the cobalt for Apple's iPhones or so are coming. Right?
Right.
And
No doubt.
that NIMBYism is a problem. Do you see it affecting prices at all? Does that factor in for you? Like when you look at the copper price?
Absolutely. That was a big deal for me. We're already operating at about a 4 to 5 million metric ton copper deficit per year. And I know, we've been discussing this on Twitter for a couple months. You can make some of that up in the recycle market. But if we are moving down the road of EVs and carbonization, there is no decarbonization without copper. Copper is still the gold standard for conductivity, and we're going to need a lot more. Goldman's metals desk, several other metals desks predict a 10 million metric ton deficit by 2035. This goes into why I believe that copper is my trade for the next 5 to 10 years. I believe that we want it so bad, and there's not enough of it, and there's been underinvestment since the financial crisis. And in that time period, something that we just hit on, the regulatory framework around mining has changed quite a bit. And I think it's going to be very, very difficult to get. Now, unless someone comes up with a way, like I believe Tesla wanted to, not Tesla, the company, Tesla, the dude, wanted to, come up with something that was going to conduct electricity to the air. I don't think that technology exists, but I'm not an expert on it.
Interesting. Yeah. No. Talking about markets in a deficit, I think silver is going to have a $200 million ounce deficit next year as well. Are you looking at silver at all? Is that in that
Absolutely.
same context?
Yeah, absolutely. Again, a year ago, so a year and a half ago at the New Orleans Investment Conference, my case was for silver, and I've been long silver, and this is in my long-term portfolio, and suffered for that greatly towards the end of that year, 2021. Now it's come back around nicely. I think that from a technical standpoint, if you look at a 20-year chart, seems like a massive cup and handle. I believe my level is on the upside, trades above $25, $26, settles above there. I believe the handle's broken. I think it heads higher. I don't think it's unreasonable for me to target $50 silver. Again, I'm not recommending anything to anybody. I just tell people what I'm doing and why I'm doing it, but I don't know the depth of their pockets, their risk tolerance. I'm going to keep silver for a long time. I think it trades back up to $50. And by the way, you're too young to probably even remember the last time it hit $50, are you?
Yeah, barely.
All right, okay.
Barely. No, fantastic. Any other trends you have on your radar for next year that we haven't talked about yet? Anything we're missing here that maybe the black swan that's on your radar screen?
The black swan to me is that. So the stock market, everyone is looking at our equity market and thinking, okay, we're in a bear market, and that's fine. I accept that too. But bear markets are not all created equal. The first year of this, you knock off the over leveraged hands, and we've done that effectively. So bear markets and corrections can be in price or they can be in time. We've had a long time of trading sideways. I'm less bearish, by the way. But again, from a technical standpoint, if we break below, let's call it 3780 in the S&P futures within the next couple of weeks, I'll think we could visit those June lows, and I'm perfectly fine with that. But I'm worried that if this recession begins to happen and multiples start to come down on these companies, and the Fed will keep rates high, the government will keep doing their whatever stupid things they're doing to try to keep inflation high, and we'll get this push-pull that could bring us into a 5-year kind of cost push stagnation. I'm genuinely worried about that, but I do have some optimism that it won't happen that way.
Interesting, like because the government somewhat is interested. I don't know, we're jumping around here, but the government's interest in keeping inflation high, of course, comes also from the debt side, because at some point they'll have to pay interest on it, or they are paying interest on the debt. And I think Brian London at the conference in New Orleans made a big point out. Eventually, you'll have to hit $1 trillion. You'll hit $1 trillion just alone in interest payments per year, which is a ridiculous number.
Yeah, that's a huge deal, and that's going to start to happen soon. But not just in government. There's a lot of revolving debt. And by the way, you said we're jumping around a lot. That's the way I deal, Kai. I thought you knew this coming in. I jump around.
I love talking with traders because it's always quick and fast. It's all over the place. Exactly.
But anyway, there's a lot of revolving debt. that's going to need to be rolled soon. And as the Fed looks at that, that's when the efficacy of these rate hikes really starts to come into play. You mentioned the government side of it, which is fascinating, that of course inflationary because they have to borrow to meet that debt service. So they will keep creating dollars. I can't imagine a situation where the Fed doesn't come back in to start buying bonds from the Treasury within the next year and a half. And you can quote me on that because, that's I think that will be a big deal when it happens.
Absolutely. Let's to wrap it up. We got to come back to the medals because I need you to pick one medal that you're going to pick for the next 12 months. If you were to bet your horse, like everything on it, which one would it be?
Well, first of all, I don't bet everything on it. The bad way to be a trader is to bet everything on it. And if I'm wrong, I can live to tell another day. I own Tesla stock, and that's not doing very well at all. But I am somewhat getting uncomfortably long copper and will increase those uncomfortable longs on a settle above 395 in copper futures. You call it 400 for just to round it up. I will be increasing that position. Not only is that my call for the next year, it's my call for the next 5 years.
Fantastic. Jim, amazing conversation. I really love jumping around with you all over the place. It was great. We covered a lot of topics. Thanks again for making the time. I know it's a quiet time of the year, so I really appreciate it and that you're spending it with us, not with your loved ones. So appreciate it.
Thank you, my friend.
Thank
I
you so
appreciate
much.
it.
And we'll link to your podcast down below as well. And where can we find more of you as well?
So at Jim Iuorio on Twitter, JIMIUORIO. The podcast is called The Future's Edge. It's on Spotify and on YouTube, and it is absolutely exploded, and I'm grateful to all you guys who watch it.
Fantastic. Thank you so much, Jim. Happy New Year. Thanks so much, and we'll catch up very, very soon.
To you too,
and
Kai.
let's see if we can get a conversation and maybe at the end of Q1 there and see where we're at. Fantastic. Thank you so much. Everybody else, thank you so much for tuning in. It was a great conversation here with Jim Iuorio. He's a professional trader, and as you've noticed, conversations with traders are always faster paced. We've jumped around a little bit. I hope it was super insightful for you. And to make sure to leave a follow, leave a like, and to hit that subscribe button as well. And what do you think is going to happen? Leave that in the comments below. Thank you so much, and we'll be back with more.